I am Assistant Professor Padma Deshpande, the coordinator of Bachelor of Management Studies. I welcome you all to this crash course series arranged for the third year BMS students under their Sem VI. First and foremost, I would like to thank our founder principal, Dr. J.C. Kurswani, and IQAC coordinator, Dr. Kushbu Kurswani, for always encouraging and motivating us to arrange such kind of sessions for the benefit of the student fraternity. Today, we are going to conduct a crash course series on the subject International Finance. This subject is under the finance specialization of third year BMS. International finance is a very interesting subject and it covers a number of nuances of other subjects like economics, financial markets, international financial arena, and many more. And to tell us more about this subject, I am obliged to welcome CA Priti Parikh from Lala Lajpatrai College of Commerce and Economics. Madam is the coordinator for BMS in Lala Lajpatrai College of Commerce and Economics. And Madam has a vast experience of more than 13 years in the field of accounts and finance. So today we have CA Priti Parikh from Lala Lajpatrai College, who has graciously accepted our invitation. Madam, I welcome you to S.S.T College of Arts and Commerce. Request you to start your video, ma'am.
Yes, very good afternoon.
Good afternoon, ma'am, and welcome to S.S.T College of Arts and Commerce. And I would like to thank you for accepting our invitation to be the resource person for the session today, ma'am. And today you are going to speak on international finance. I would hand over the session to you, ma'am. Thank you so much.
Thank you so much. This is a very good effort, and we will like to praise the S.S.T College for the third year BMS student when many of the students cannot come offline, although after it has been started. But because of such a crash courses, they are definitely going to get benefited by for their enriching the knowledge. Forget about the exam. Enriching the knowledge is very important because knowledge is supposed to be an investment. Before I start on my subject, international finance, I'd like to share my PPT. International finance is, although you're studying this as a elective of finance for the third year BMS student under the title finance elective. But if you look today, after pandemic COVID-19, the entire global world has become one market. People have learned to buy globally, buy online, and make a payment also online. So whatever article, the product which were not available in the local country can be imported online. And for that, the payment options are available. You can pay in that country's currency or in your own country's currency. And this is possible only because of the subject international finance. So in a changing scenario, the basic knowledge regarding international finance, every student should be able to collect, recollect, and keep it in their mind. When we talk about what is international finance sometimes is also known as international macroeconomics. And it is a study of monetary interaction between two or more countries, focusing on areas such as foreign direct investment or currency exchange rate. It is a very wide topic. In a third year BMS student in the syllabus regarding foreign direct investment, it is not much cultivated. Maybe when they go to MCOM and they take the subject, it has been enlarged there. But a basic knowledge of currency exchange rate is definitely explained out over here. So when we are talking about what is international finance, the important thing for what is international financial management or what are the international financial decision, that also has to be very clear. When you talk about international financial management, it is also known as a management of finance in an international business environment. That is trading and making money through the exchange of foreign currency. And that is possible because nowadays everything has become, the digitalization has increased, the e-commerce platform has increased, and so much of importance is given to the international finance. This subject is divided into 4 units, and the first unit normally tells you something about the introduction to international exchange finance, then something about the international capital budgeting, then international tax liability, then the forward rate, and the capital budgeting, international capital budgeting decisions, and so many small chapters are covered under it. It's a huge subject. We like to cover up in our study, in our this 1.5 hour the session. We like to cover up the basic, the fundamental, the important points in the subject, in the syllabus. We first define what is exchange rate. If I wanted to buy my the blood pressure machine online, if I check, I wanted to have some European make or some American make, then in India, when you check on your Google's site or on some pharmacy site, you get that the payment is something around 2,000 to 3,000 INR. But the same make, if it is available on Amazon in that currency's country, suppose it is a Hong Kong make, and if I go to Amazon and find out that in a Hong Kong dollar, HKD, then you can compare that you have to pay very less amount when you have to because of the conversion of Hong Kong dollar into INR at a particular point of time. So for any individual citizen, for any individual student, you have an option to buy from the local market into your local currency or into the foreign market into the foreign currency. So foreign currencies, if you buy, you will have to buy that foreign currency. You'll have to pay your local currency. So for that, you should know what is exchange rate. The foreign exchange market provides an environment for establishing the demand and supply equilibrium between the country, between the currency, based on which rate the conversion is established. Many times the foreign exchange rate is called as the exchange rates, and this exchange rates will denote for one foreign currency, for one American dollar, for one Great Britain pound, for one euro, how much of you will have to pay into your local currency. In our case, it is in India. So the local currency is INR, Indian rupee. So for buying one foreign currency, how much you will pay your local currency? That is called as a foreign exchange rate. All foreign exchange transactions operate through bank system, and therefore the bank operating at the financial level and dealing in foreign exchange constitutes the foreign exchange, the market. So the concept of geographical market is elevated. The market is not one place. It has become, the entire world has become one market, and you can buy anywhere, sitting at anywhere. You can order anywhere food from food for your the digital equipment. You can order and buy from anywhere in the world. The most important definition is the price you pay for exchanging some other country's currency in your own currency is a foreign exchange. The rates in the foreign exchange market are determined by the interaction of the forces of demand for and supply of the commodity that is a foreign exchange. It has become a convention. There's no rule, but all the country denotes the currency in a 3 capital letter. The first 2 letters for the country, the third letter for the currencies. The chart is here in front of you. The international finance has to be, there's no force, but everybody wants to do in a very conventional way, so that it is understood by a different people situated in a different geographical location, separated by the international by the international boundaries. USA is US dollar, USD, and UK has Great Britain pound and Japanese yen and euros and INR, and Switzerland has got Swiss franc, which is called as CHF. Canada has got Canadian dollar, CAD, and Australia, AUD, and Singapore, SGD, and Sweden, the SEK. It is very easy. There's no question, but sometimes in your exam, in an MCQ 1 or 2 mark question, always comes to know the full form of the abbreviation given or the currency to be provided for a particular country. The most costliest currency is KWD, Kuwait dinar. And then we have the Oman Rial, OMR, and Saudi Arabian Rial. There are so many currencies in the world as there are the number of countries in the world. The foreign exchange quote has to be quoted in a particular way so that a customer or a buyer or an importer or an exporter can understand the foreign exchange language. So it is normally denoted by base currency and a variable currency, which is also called as a quote currency. Base currency means a currency of the country in which you are giving this quote. You're going to tell you about the international finance rate. So spot rates are quoted as 1 unit of base currency against the number of units of quote currency, that is a variable currency. So when I say EUR/USD, EUR is supposed to be my base currency and USD is supposed to be my variable currency. And this quotation is available in the variable currency country, that is USA. In USA, you are able to provide whatever the fractions or the denomination of US dollar is needed when you're demanding in euro, 1 euro, correct? So 1 unit of base currency is equal to X unit of quote currency, and another name for quote currency is a variable currency. In the quotation EUR/USD, EUR is a base currency and USD is a variable currency. When spot rates are quoted, the first currency always represent the base currency, and the second currency is a quote currency, the variable currency. For here in the quotation USD/CZK, it is CZK is Czechoslovakia's crown, and Czechoslovakia crown is a variable currency. This quotation is available into the Czechoslovakia, where you can say that I can give so much of CZK to buy 1 USD. When we talk about SWIFT codes of each currency can be identified by a 3-letter code. The first 2 letters denotes the name of the country, and the 3rd letter refers to the name of the currency. And these codes were used by the SWIFT message system and have become an internationally accepted standard. Few examples of quotation are provided out over here. When we read GBP/INR 76.9950-00, we come across that in foreign exchange currency, they are quoted with 4 decimals, and that also rounded off. The last 2 decimal, which are the fraction of the paise in India, are called as PIPs, pips or points. They are called as pips or points. So, and one golden rule is always followed, that the ask rate should be greater than the bid rate. But what is bid rate? What is ask rate? The quotations are normally provided by foreign exchange institution, by bank, because we have learned that the supply and demand of currency will decide its quotation exchange rate. So when this quotation are given by the bank will always have 2 different quote, one to buy the currency from you and one to sell the same currency to you. So, but obvious, the price at which they sell the currency will be a little bit higher than the price at which they buy from the currency. That means if you have got 3,000 US dollar before going to a trip to USA, before going to study in USA, you must have paid a different price. Say today's rate is 72 INR. But after the trip is over, after 3 years of study is over, or after the 1.5-year course is done and you return back to India and you have a leftover, the residual US dollar, and you want to give back to the bank from where you bought it in order to convert into the currency which you can use in the present scenario. So now when they buy from you, the rate will not be the same as the rate at which they sell to you. This is the reason why we say the first golden rule is that the ask rate should be greater than the bid rate. The ask rate is a sell rate by the bank, by the institution. And bid rate is a rate at which they buy from the customer. And bid and ask rate are very relative. So when I buy from bank, they give me at the ask rate. But when I sell to the bank, they give me the money according to the bid rate. It's a very simple mechanism. The concept is buy and sell, but because there are two parties, who is buying, who is selling, to understand that concept, the technical word bid rate and ask rate is given to the bank. When I buy, it is buy. When the bank buys from me, it is when bank buys from me, it is a bid rate. When I sell, it is a sale. But when the bank sells to me, it is at ask. Very simple. And because of the reality that we sell always at little higher the price, the ask rate is supposed to be the greater than the bid rate. So in the given case, base currency is a Great Britain pound and the variable currency is INR. The bid rate is 76.9950 and it should be immediate higher number, which is 00 at the pips point, the fraction of the paise. It will be 77.0000. 77.40 will be your answer. Same thing. If you have 1.2596 as your bid rate, the next rate should be a little bit higher. So that's going to be 1.2602. The base currency is US dollar and variable currency is EUR, that's Eurozone. For the third quotation, the base currency is US dollar and the variable currency is INR, but the bid rate is 65.9985. While the ask rate will be higher than that, that is 65.9995. USD JPY 101.2505-95. The bid rate is the bid rate is 101.2505 and the ask rate will be higher than that. So 101.2595. The base currency is US dollar and the variable currency is Japanese yen. When we go to Euro INR quotation, the Euro is the base currency, in the INR is a variable currency, which is also called as a quote currency. 63.7380 is your bid rate and 63.7410 is my ask rate. Foreign exchange rates are quoted by banks on a two-way basis. The left-hand side rate in a quotation is called as a bid rate, and the right-hand side is called as an ask rate or offer rate. The difference between the ask rate and the bid rate is given in given quotation is called as a spread, which is denoted by the formula ask minus bid. And since ask is always greater than bid, the first golden rule, the spread is always positive. Foreign exchange rates are normally quoted up to 2 or 4 decimal places in India. And for the general practice in the interbank market is to quote rates up to 4 decimal places. So the ask rate is the sell rate by is a ask rate, is a sell rate by the banker, the price at which they sell the currency to me. The bid is the price at which the market will buy a currency pair before any commission or fees, and the offer or the ask rate is the price at which the market will sell the currency pair before any commissions or fees. What is the difference between a bid rate and an ask rate? The difference is same as buying and selling by one single person, but buying is always lower and selling is always higher. So the bid price refers to the highest price a buyer will pay for a security, for an investment, for a currency. And the ask price refers to the lowest price a seller will accept for a security, for a currency, or for an investment. Correct? The bid is always lower than the ask rate in a foreign exchange, because the ask rate in foreign exchange is higher than the bid rate simply because a broker needs to run on some sort of commission, which is called as a forex bid-ask spread. The spread is the amount what the broker will earn by providing you the foreign exchange services, by giving you the currency available, by calculating how much currency you needed for a particular amount of your local currency. They provide you the services for which they charge you commission, and that is a difference between the buy rate and the ask rate. That is a spread. Okay. When they ask you that the spot rate, if they give you, suppose if I wanted to go to Spain and I want an euro, so if I go to a grey market at Colaba and ask them, how much is 1 euro for, and it says that it is 83 INR, that is called as a spot rate. The spot rate is always quoted in two different values. The first rate is a buy rate or a bid rate, and the second is a sell or a ask or the offer price. But the grey marketers offer only one price, 83 rupees. So they buy also at 83, they sell also at 83. So that price is called as a spot rate, but a single quotation. So when we are dealing in a foreign exchange market, we are dealing in a foreign exchange transaction, we are doing an international business, there are a lot of unconventional way we come across. They write anyway the quotation, they write by anyway currency, but your quotation should be always be in the form of first the base currency, then the base currency, then the ask, then the variable currency, then the bid rate and the ask rate. Now we go to know what is a direct and an indirect quote. Direct quote and indirect quote. It is so simple word. When I pay my fees directly to the college, it is called as a direct payment of fees. When I pay my income tax directly into the treasury of the government, into the CBDT department, Central Board of Direct Tax, it is called as a direct tax. But when I pay my fees to my friend and request him to pay the fees to the college because I was not returning from my native place before the payment date gets over, that is an indirect way of paying the fees. And when somebody else collect tax on behalf of me and pay to the government my taxes, it is called as an indirect tax. And your indirect quote is a quote by which you are going to give your currency to buy somebody else's currency. So there are two ways to quote a currency pair, either directly or indirectly. And a direct currency quote is simply a currency pair in which domestic currency is a quoted currency, while an indirect quote is a currency pair where the domestic currency is a base currency. So a direct quote is a foreign exchange rate quoted in fixed units of foreign currency in variable amounts of the domestic currency. For example, in the international market, most currencies are quoted against the USD. In this case, USD is usually the base currency. For example, USD CHF. USD is a base currency. CHF, Switzerland francos, is your variable currency. So this quote is a direct quote for Switzerland. When you go to USD NOK, so United States dollar, and NOK is a Norwegian krona. Your Norwegian kroner is, Norway is a country where this is a direct quote, okay? But when you have a USD in another place, in the variable place, it becomes an indirect quote for USD, indirect quote for America. Direct and indirect quote will help us to understand the difference between the two. There are a lot of difference between a direct rate and an indirect rate, but one thing is most important, that in this business, in this entire world market, there are many currencies like Greece and the Lira of Istanbul, which are lower than Indian INR currencies also, but they are not much demanded in the international market. So when you demand INR and when you demand JPY, they never demand for 1 INR, 1 JPY. They always demand for 100 INR and 100 JPY. That you have to keep it in mind when you're appearing for the TYBMS paper. INR, when it is in a demanding position, when it is in a base currency. JPY, when Japanese yen is in a base currency in a demanding position, they has to be prefixed by 100. That has become a conventional because of our trade balance being unfavorable, because of a balance of payment being unfavorable, because of the demand for a product, but the foreign exchange rate is not so high to cover up the losses. We are people demanding for Indian currency always in 100 INR, how much they have to pay, right? Direct rates were introduced on 2nd August 93, where indirect were used on 2nd August 1993. Indirect rates in India were expressed to the base of INR 100, and Japanese yen is also expressed to it. There's a concept of cross currency. A cross currency means that when you have two different quotation, the bank cannot provide the quotation for each and every currency in the world. But if they provide a few quotation, and when you do mix and match this quotation to get what quote you want for your currency, that is called as a cross currency. For example, when a currency quote is given without the US dollar as one of its component, this is called as a cross currency. For example, the most common currency pairs are the Euro GBP, Euro CHF, Euro CHF, Euro JPY. And they also explain you, because you have a theoretical paper more due to the university decision to take an online paper for your semester. You might not have to solve the cross currency, but they might ask you the simple calculation as if it is USD CAD, some figure is given to you and CAD Euro is given to you, then we use a chain rule. X upon Y into Y upon Z gives you X upon Z, because YY get eradicated. The same way, USD CAD into CAD Euro. If you do the CAD get eradicated and you have USD Euro. The same thing you do with the numbers provided to it. There can be the cross currency for the bid rate also, and a cross currency for the ask rate also, but you find out the cross currency rate simply by an equation X upon Y into Y upon Z is X upon Z. The cross rate refers to the exchange rate between two currencies, each of which has an exchange rate quote against a common currency. So they want to have an exchange rate between two currencies where they are both bound by a common currency in which they can talk about. For an example, suppose if I'm going to if I am going to my daughter in USA, and on my way the flight halt at Dubai, and I want to buy some dates for her. I don't have a Dubai dirhams. I don't have Arabian Emirates dirhams. So then I will not be able to buy from a duty-free shop. The two currencies we are talking about is AED and INR. I have INR. I'm going to USA, so I might be having US dollar, but I didn't have the duty-free shop AED with me. So in that case, for that date, when I pay the dirhams money, what he is asking into the US dollar, and that calculation, how much US dollar I have to provide, is called as a cross currency. We have already done with the vehicle, we have already done with the base bid rate and the ask rate. We go to vehicle currency. Post-independence for India, the vehicle currency is US dollar because it is that currency in which any payment can be made. Any payment can be made. Like if you are going on your way, you want to buy something in Lira. If you don't have Lira, then they accept US dollar. If you want to buy something from Kashmir into Indian rupee, if you don't have Indian rupee, they accept US dollar. So vehicle currency is an international foreign exchange market. It's an aggregate of individual markets operating in each country at the start of every trading day. At the start of every trading day, the value of the domestic currency in each country is locally established against any one major universally accepted international foreign currency, and that is called as a vehicle currency. A vehicle currency, in the sense defined, is a medium of exchange between other currencies. Although you might you have a bill in Arabian dirhams for the dates what you're buying, but if you have if you are going to pay in United States dollar, they'll be charging to you they will be charging to you, converting them into the they'll be charging them into the dollars and be providing a bill both in a dirhams and a dollar. Currency is a medium of exchange currency is a medium of exchange for goods and services. It is in short like a paper. It is a short like a money paper in the form of a paper or form of coins, usually which is issued by the government. And this vehicle currency is also confirmed by the government. For us, it is US dollar is considered to be vehicle currency. Any payment what you want to make, you can make in the form of the international current in the form of the US dollar as a currency. Correct. I would like to give me a moment to share my second PPT. Till that, if you have any doubts, if you want to clear anything, if you want to ask anything, you can definitely ask me. In international finance, I would like to tell you about a case that in case when you have your few friends of you and you want to decide that nowadays many of the friends are in native place, are at their own hometown, and if they find that the dollar at present is available at their place in Jaipur, suppose one of your friends stays in Jaipur and he happens to be at bank when you called and he said, oh, dollar has reduced so much, it has reached to 72 INR. And then you say, no, nothing. In Mumbai, it is available for 74 INR. When you come across that point of time, you both can decide, you can request him to buy him some US dollar at 72 and transfer into your account to Mumbai, which you can sell at 74 and earn the money. That is called an arbitrage. Arbitrage is by mistake misunderstood to be a gambling, but there are official professional called as arbitrageurs. Arbitrage is simultaneously buying and selling of securities, currencies, or commodities in a different market or in a derivative forms in order to take the advantage of differing prices of the same assets. But normally the prices are determined always by the demand and supply. So it is not possible. Okay, there will always be the difference in a price such a huge that you can make a profit. It is only going to be a profit for a particular moment of time. And it is you who have to find out that moment and take the advantage of it. For example, suppose that boy in Jaipur, he found out that the price for a US dollar is there 72 and he asked him to buy directly 10,000 US dollar. So the demand for US dollar increased in Jaipur. So the price from 72 INR rose to 73 INR. And the same way, you didn't buy the US dollar in Mumbai. So in Mumbai, the price for dollar fell down And because the price for Mumbai, the dollar fell down, it reduced from 74 to 73. The equilibrium was established between the Jaipur price and the Mumbai price. So it is a very small fraction of a moment when you can find the difference in a geographical market for the currency, and it is who you take an advantage. That is called as an arbitrage. Arbitrage occurs when an investor can make a profit from a simultaneously buying and selling of a commodity. It is not only in currency; it can occur in any of the other traded goods, the short money market goods. For example, gold may be traded on both New York and Tokyo stock exchanges. So finally, arbitrage is an investment strategy in which an investor will simultaneously buy and sell any asset, any monetary form in a different markets to take advantage of a price difference and generate a profit. That is the most important concept what you should be knowing it about them. That it should be definitely dealing to make you a profit. In gambling, you might have a profit, you might not have a profit, and gambling is especially only for the fun purpose. In speculation, you might have a profit, you might not have a profit, but if you have a profit, it will be huge, a fantastic profit. But in case of arbitrage, you might have a profit 100%, but it might not be as huge as you find in the case of a speculation of the currency. Correct. Then we go to the next one. Arbitrage comes, there's nothing wrong to do with any arbitrage opportunity if you come across, but you should be able to utilize that opportunity within a fraction of a time. Your sources should be very easily available. Arbitrage trading is not only legal in the United States, but it is encouraged in every part of the world. Furthermore, arbitrageurs will help you to have an equilibrium among the different prices in the different states of a country. Is arbitrage risk-free? Arbitrage funds are often promoted by fund houses as a risk-free investment. The profit in arbitrage strategy is a difference between the price of the instrument in a different market, like in a cash market or in a derivative market, for instance. The truth, however, is that arbitrage funds are not risk-free. There is a risk involved in it. There is definitely a risk involved in it, and there's definitely you are going to if you ask them to buy at a Bangalore, and before you can sell in a Mumbai, the prices reduces. You are at a risk of conversion, risk of liquidity risk there. Okay, is a forex arbitrage? Yes, forex arbitrage is a risk-free trading strategy that allows a retail forex traders to make a profit with no open currency exposure. There's no risk into it. This type of arbitrage trading involves a buying and selling of a different currency pairs to exploit any price inefficiency. Inefficiencies maybe because of a geographical location, inefficiencies because of a political problem. And what is a pure arbitrage? It is not only dealing with the currency, but for a buying and a selling of a particular asset, which can occur simultaneously to gain profit due to a price imbalance in the market, is a pure arbitrage. Arbitrage is widely used practice. We have to learn in a TYBMS two types of arbitrage: the geographical arbitrage and the triangular arbitrage. Geographical arbitrage can be asked with a single quotation, or it can be asked with a double quotation. For example, exchange rates are an important form of arbitrage. If the exchange rate in London is GBP 1, which is equal to US dollar 2, while the exchange rate in US is GBP 1 equals to $3, then a smart consumer can make a profit simply by converting their money from dollars to pounds in London, then converting it back when they return to US and get the profit in between. The advantage of it. Arbitrage around the world. Arbitrage is a core aspect of a global economy, and it is a part of each and every commodity market which are traded in a short-term market, short-term money market. Selling vintage clothes on Etsy, or a major investor trading billions of dollars across currency market. Ultimately, it comes down to the oldest rule of investment: buy low, sell high. Forex arbitrage is a risk-free trading strategy because you know you have already got the dollar with you. Even if you can't sell them, you can use in a different mode of life, but the price is always going to rise. It allows a retail forex retailer and a forex trader to make a profit with no open currency exposure. And this strategy involves acting on opportunities presented by pricing the inefficiencies in the short window they exist. There are types of forex arbitrage. Two currency arbitrage is the exploitation of a different quotes of two currency instead of the difference in the price between a two currency and in the same pair. Covered interest arbitrage is a difference in the interest charged by the different people in a different world. Covered interest arbitrage is a trading strategy in which a trader exploits the interest rate differential between the two countries while using a forward contract as a hedge to cover the exchange rate risk. So you have an arbitrage in currency, the two-way quotation, you have arbitrage in interest arbitrage, and you have a triangular arbitrage. Triangular arbitrage arises from the difference in the price between the three different currencies and the conversion of one currency into two other before it is converted back into the first currency and hopefully always at a profit. This is an example, just as an example of currency arbitrage. Let's suppose that two different Bank A and Bank B, have a set different rates of Euro USD. Bank A is buying €1 at 1.6100 and selling it 1.6200. So 1.6200 is an ask rate and 1.6100 is a bid rate. Bank B is buying at €1 at 1.6300 and selling it 1.6400. And in this example, a trader could sell those euros to Bank A, which is buying for 1.6200, and then immediately selling those euros to Bank A, which is buying for 1.6300. If the trader does this with an initial investment of 1 lakh million US dollar, they could make a quick profit of 1,000 US dollar. However, the trader would need to act faster after spotting these discrepancies in the pricing, because as soon as a few traders notice, the forces of supply and demand will cause the bank to adjust the pricing, and opportunity for the arbitrage would be lost. So if there is arbitrage, it is definite that the arbitrage will earn into a profit. But when will it happen? What time will it happen? Is always a mystery. And a covered interest arbitrage is normally related to the different borrowing in two different situations with a two different interest rate. And it's a huge procedure. First, you buy whatever you want to borrow in different currency, convert them into your own currency, use them somewhere so that it can generate a money, and this money can be rewarded back to the currency in between the interest rate changes, and there you make a profit. Triangular arbitrage is nothing. There you have to check between three different currencies and find out where you can make a profit. And where you can make a profit, and this profit can even be utilized for further development of the currency. For an example, Euro USD, Euro GBP, GBP USD. The exchange rate between Euro USD at Bank A is suppose 1.1500 and Euro GBP is Bank B. This is a single quotation, 1.2000. And GBP USD at Bank C, the exchange rate is 1.250, the product of both of them. So here we finished two concepts, the base, the bid rate and the ask rate, the vehicle currency, the cross currency, and the arbitrage gain and the arbitrage profit. You might have some questions related to the calculation part. Give me a moment to change my slide. We go to one more concept in international finance as international capital budgeting. You have heard about foreign direct investment. It came into the product, it came into the assets, it came into the property. So many people have a bank account in Switzerland. So many people have a property in Singapore, right? So we go to find out about international capital budgeting. I hope my slide is visible. International capital budgeting. There you find out the asset is divided into two parts, the short-term current asset and a long-term current fixed assets. And when we talk about short-term, it is called a working capital management, but a capital management is always on a long-term or a fixed asset. What is capital budgeting? The system of capital budgeting is employed to evaluate the expenditure decision which involves current outlays, but are likely to produce benefit. So, thoda paisa, if you spend some amount of money in the starting today and your investment which materialize in the future is called as international capital budgeting. Capital expenditure management therefore include addition, disposition, modification, and replacement of fixed assets. So it involves a huge amount of money. And when it involves a huge amount of money, the decision has to be very, very perfect, otherwise you're going to suffer. So it is a process of investigation and analysis that leads to a key financial decision for both purely domestic firm, for an individual, for an MNCs. It is called as a capital budgeting decision. Basic features of capital budgeting decisions are they're potentially large anticipated benefit. उनको अगर मुनाफा हुआ तो बहुत ज़्यादा होगा. Not unless like what you study the arbitrage. And the decision also involves a huge amount of degree of risk. A relatively long period of time between initial outlay and anticipated return is called as a capital budgeting. The amount for which your money get changed from its own position in order to utilize them for the future purpose, but keeping them in a safety is making you going to lose your interest part of the capital budgeting. So a relatively long period of time between initial outlay and anticipated return is necessary to take a capital budgeting decision appropriate. What does the capital budget process include? Project generation, find out what you want, how you want to deal with the problem of your increasing your production or expanding your business, or how you want to how you wanted to go for the diversification, how you want to go for mergers, you want to go for acquisitions. And then once the project generation is finalized, you have to evaluate the different projects available in the market. Will you start the manufacturing unit, or will you go for an assembling unit? Will you go for the project A or will you go for project B, and on what ground? The project has to be evaluated. And that is done when you follow the technique of capital rationing. After you decided that you wanted to go for the assembling part or for the manufacturing part, you select the project and then go for the execution of the project. So capital budgeting process in international is also very important. If we have to import the Japanese machinery, then you have to calculate the cost of importing that machinery, conversion into that conversion cost, the changes in the exchange rate quotation, the cost involved in calling the technician when something is wrong or for its installation, all that cost has to be taken care of. Otherwise, your capital budgeting decision will be wrong. Importance of capital budgeting decisions are very simple. It determines the future destiny of the company. The firm's cost, the break-even point, sales, and a profit will be determined by the firm's selection of assets. So if you take your capital budgeting decision important, if your international capital budgeting decision are taken very widely, very versely, then you will be able to make the profit out of the arbitrage transaction or of the forward transaction or of the future transaction, and can utilize this transaction to increase the foreign exchange reserve of the country, which will be able to help to make your favorable balance of payment, favorable balance of trade, and will help us to reduce the tag of demanding only 100 INR to 1 INR. The capital investment involves cost, and majority of the firms have scarce capital resources. You work very hard to arrange the fund for your company by going to IPO, by going to the debt, the public issue of the debt or whatever. And the money which is collected has to be optimally utilized. And for that, the capital budgeting decisions are important. The technique of capital budgeting is similar between domestic and a multinational firm. The only difference it appears in the complexity appears in the case of a multinational firm, because a lot of obligation, a lot of forms has to be filled up, and a lot of follow-up has to be done. Capital budgeting in MNCs encounters a number of variables and factors that are unique for a foreign project. But once a foreign project starts, it gets a huge amount of benefit. Like, for example, the government can favor them, can give them a tax subsidy, can give them the tax favor, the labor at a cheaper rate, and all as it is provided in a says the special economic zone or a SIBS at Santa Cruz. What about the problem issue related to the international or a foreign investment or international capital budgeting? You always have to compare between your project in your local hometown with the project outside the country, or project which involves the other currency. Exchange rate differences has to be noted, the ups and downs has to be studied, and the inflation risk also has to be taken care of, because the inflation rate has increased from 6% to 8% to 9% at present. So will it be the same cost when you actually start your production after implementing the machinery? You also have the problems about the tax treatment also, because it changes every year. Political and economic risk is associated with it. So, for example, take the case of this year, the war between the Russia and has stopped the flights going aboard them, or stopped the import of oil from them. And because of that, because of the political risk, the investment analysis, the capital budgeting decision, the international financial flow is affected. And block funds. Once you decide to take an international financial capital budgeting decisions, your huge amount of money is blocked up unless the machinery is received and unless the machine starts working on it. And amenities and concession granted by the host companies are also sometimes unfavorable. Like we see that in India, a lot of Chinese lights and a China product are dumped during the Diwali time. So it affects the local consumption, and an appeal is made to the normal people not to buy the cheap product, but to buy the good product from the home producers. Capital budgeting decisions are of three important points: accept and reject decision. Either you take it or leave it. They are called as indivisible capital budgeting assets. Mutually exclusive project decision. You come across two projects, A and B. Either you can take A or you can take B. You cannot take both A and B. You cannot leave both A and B. Capital rationing decision. You have some amount of money with you, which you can buy the project, and you will decide what will be the best for your company. How will you be able to take the best for the company? The capital budgeting decision should be able to give you the incremental cash flow. What is the use of making a huge capital budgeting decision if they cannot generate the revenue income, which is for years and years? It is an additional operating cash flow that an organization receives from taking on a new project, and it includes different type of costs, like as the sunk cost, the opportunity cost, externality, cannibalization, and all. The most important regarding the international capital budgeting problems are that these problems are sometimes leads to the stoppage of work. They do not allow you. The tax issue for multinational capital budgeting will make the project does not work for the huge period of time. The political relationship between the host country and the home country will also make it a different position. Different position for the company to do the processing of the international project done for the foreign direct investment, for the foreign direct investment in a foreign direct portfolio management. It is necessary. There are a few important things what you should know about is a cannibalization and a fees and a royalties and a opportunity cost and a transfer pricing before you jump into the international capital budgeting. There are the few difference for whether the repatriation of profit, what does it mean, and a repatriation of tax, what does it mean, and what is a project office and what a branch office and what wholly owned subsidiary will help us to solve and reduce the risk of making the entire world as one market. Okay. So small topic are covered from your syllabus in order to see that you will be able to answer the MCQs which you are going to give an online exam on the 5th of May 2022. The capital budgeting techniques are of two types, the traditional and a modern. Traditional does not take into account the concept of time value of money. Today's money is more valuable than what you receive in future. They just do the calculation of a payback period, in how much time you get back your money, accounting rate of return, the return what you can earn on your accounting profit, and a profitability index, which is also called a benefit cost ratio, which find out the difference between them, which can find out the difference between the price and amount what you spend for the price. Then we have a discounted payback period where you use a time value of money to find out in how many years you get back your discounted cash back. Net present value, which is the difference between your inflows and outflows, and that inflows and outflows. And again, internal rate of return is again one of the important mode of the capital budgeting technique. So one of the other important capital budgeting technique has been done, and we would like to go further for the one more and the last PPT, which is for the international tax environment. Many things has to be covered up. We are trying to cover up in a nutshell so that the basic is provided and you will be able to understand the concept and MCQs related to it. International tax environment, a tax liability, is again the most important thing which can help you to take a decision related to the international capital budgeting, international project choosing. We can help you to know about the forward contract and the forward exchange rate and the covered interest arbitrage and the borrowing and investment decision. International taxation. International taxation covers the tax laws of different countries or the international aspects of the law for various individuals and businesses. There is a concept of tax neutrality, the tax equity, which tells you that Every country has their own way of indulging into the collecting a tax, a price what they pay for civilization. Tax neutrality means the capital export neutrality and the capital import neutrality. And tax equity, as the name suggests, it focuses on the same tax rate, same tax policy, same tax due date, which would apply to each and every country with an affiliate of MNC earning a taxable income. Well, suppose if you have the Citibank in India and a Citibank in New York, they will be paying the same tax rate if there's a tax equity being followed by it. We go for a tax havens. The tax havens includes the countries with a low corporate tax rates and the low tax rates withholding on a corporate business. Many South Asian countries like Singapore and Myanmar and Bangkok, they provide you this facility that you open up as per the requirement a few type of industries there. The profit what you earn is not taxed for so many years, and that can be retrieved back. And so they are called as a tax haven. A tax haven is defined as a country or a place with very low effective rates of taxation for a foreign investors. And in some traditional definition, this also offers a financial secrecy. You can find so many accounts in the Swiss bank. The reason is a financial secrecy. However, while countries with high level of secrecy, but also with high rates of taxation, can feature in some tax haven list, they are not universally considered as a tax haven. In contrast, countries with lower level of secrecy, but also low effective rate of taxation, appears in the most tax haven list. So tax havens were once useful for the location of a MNC to establish a shell company. So this tax haven concept, international tax haven concept, helps us to take a decision related to the international capital budgeting. We go to global tax liability. The liability which arises on the entire globally when you trade, in import, when you export, when you buy machinery, when you take a loan. And what is a global tax liability tells you that. It is the company's total tax liability. And from the individual is borrowed, the company has paid, whatever the liability of the entire company's total tax liability is considered to be a global tax liability. However, many surveys shows that the sweeping charges to the tax code and a volatile international trade relation are competing for the bulk of in-house tax professional time and attention. So to analyze this, the sum of all taxes, income and non-income based taxes owed at international, federal, state, local level allows the tax professional and the peers to make better business decisions, from mergers and acquisition to hiring and establishing operation abroad. And this is analyzed as a total tax liability for a more imperative. Then there is a foreign affiliate, there's a general strategy, transfer pricing, repatriating profit, what you've already studied. Transfer pricing has also become one of the important for the international foreign exchange transaction. And here they reduce a global tax liability. Let foreign operation in a low tax jurisdiction manufacture and mother company for selling in the home market. The foreign affiliate generates substantial profit that are taxed at a low rate. And repatriating profit, companies can use successfully transfer operations and profits to low tax foreign location. But at some point, some of these profits must be brought back to the home country to finance a local operation, pay dividend, and support acquisition and other financial operations. That's a global tax liability. And now, because the 1 hour we are try to cover few of the concepts among which are very important for you to study, we'd like to explain you some of the MCQs which are supposed to be coming for your, or which are supposed to be part of your this semester, this semester and exam. For that, we always go understand the reason for the reason for the choosing it on the basis of the correct answers on the basis of an elimination round. We have learned about a nostro, vostro, and a loro, and a correspondent bank. What do you mean by nostro? A nostrum is my account with you. When a country's State Bank of India Camps Corner branch opens an account in US, in America, in New York, into the Citibank of America, in the name of State Bank of India Camps Corner branch, and open the account in US dollar, that is called as nostro, our account with you. But when the same Citibank of New York opened an account in the Punjab National Bank of India, it is termed as a vostro, your account with us. And the last part is loro. When you don't have any account or any reference to be referred in the future, in that case, in that case, you refer them that they should do the transaction depending on the third party's concern. And if this is done, we always refer to them as a loro transaction. So the first one, when we say the first one is I hope it is visible. See, the first one is SBI account in HSBC in UK is an example of HSBC, Hong Kong Shanghai Bank, uske in UK mein hai, and they got and they open up an SBI account. So it is called as what? Loro, Nostro, Vostro, Zoro. It should be called as a, because SBI is opening an account, it is called as a Nostro account. This is called as a Nostro account. Then we go for the next one. For India, 1 USD is equal to INR 75 is a dash quote. They are asking you, this is a quote, direct quote for India or an indirect quote for India. For that, we should see which is a variable currency, the currency where the number changes, and that is here the INR. So if in variable currency there is an INR, then it is a direct quote and a direct quote for India. So this is a direct quote for India. The third one, the calculation of cross rate, that is cross rate, there is a need of dash currencies. Cross rate, there is a need of, we are going to find out between two pair of currency, one common currency. And for this cross rate, we need one help of a vehicle currency. So we always wanted a 3 currencies together. And the basis of any currency, 1 pip, is equal to how many points? Because I told you it is a fraction of a paise. After 2 decimal it comes. So it should be denoted by 1,000 points, 1,000 points. IFRS stands for, this little theory also inclusive out of it. And IFRS stands for reporting standard, but International Financial Reporting Standard. Please remember, International Financial Reporting Standards. Both Bank of America account with Bank of Baroda in India is an example of your account with me. So it is a vostro. Yes, one we missed out. No, we didn't miss out. It is the next question only. If a pair of shoe, now see, check this, very important. If a pair of shoe costs rupees 3,500 in India and $15 USA, That means $1 is equal to rupees 70 INR is an example of purchase power parity theory. PPP theory, purchase power parity theory, which determines the exchange quotation rate on your purchasing power. The current system of international finance is not a fixed, so it is a fluctuating exchange rate system. But sometimes it is intervened by government, so it is called as a managed fluctuating exchange rate system. The foreign exchange of a country is known as a dash currency in a two-way quote. Two-way quote means there are only two possibilities, either the ask rate or the bid rate. So because it is a foreign currency, it is supposed to be your base currency. Domestic currency is also known as, there's another name for domestic currency, and that is the variable currency. Bretton Woods system uses dash peg system, that is, they uses the crawling back system. And then geographical arbitrage, bid is greater than ask. So yeah, then only you'll be able to make a profit. Normal rule, golden rule, ask is greater than bid. But for the geographical arbitrage, it should be more than the ask in order to make a profit, the arbitrage profit. If the quotation USD says GBP 1.2433-00, in this case bid value, the bid value is the first value 1.2433. The ask rate was different, but the bid rate was clearly given to you as a first value. Their account with us is used for Loro account. So all the three has come, my account with you, your account with me, their account with you, my account with you, our account with you is nostro. Your account with me is vostro. Their account with us is loro. Okay. Demand and supply is used to determine the exchange value of a currency in the fluctuating exchange system. They only can decide what is the price and all. Dash refers to us selling a product at a higher price in the home country and a low price in a foreign country, and that is called you sell a product at a higher price in home country and a lower price in foreign country. So that is called as anti-dumping. Anti-dumping, and the increase in the interest rate cause a country's currency to, when the interest rate increases, the currencies of the country will be depreciating because it will be available. If the interest rate increases, the currency, you will have to pay more for it. So the value of it is going to get depreciated. Invoicing in home currency is an example of dash technique of foreign exchange risk management. Invoicing in home country, apne country mein, apne country ka bill banao. That's the technique of foreign exchange risk management, and that is called as an internal technique of foreign exchange risk management. Dash refers to making payment in advance before the change of rate, and that is called as leading. Before they change you book your order before you want to sell, and before you want to buy, you want to have an equilibrium price. So it has been bought at the change of rate. Future contract are dash contract, are over-the-counter contract. A dash option gives a holder the right to buy underlying asset. So these are related to the options. A dash option gives a holder the right to buy the underlying asset. Buy, if you're going to buy, then, and if you're going to sell, the buy is a call money, and put is a sell money. In case of arbitrage, there are three quotations available. Three quotations which are available in case of an arbitrage. speculator attempt to dash from rising and falling prices, try to in case of triangular arbitrage, there are three quotations available. Speculator attempt to dash from rising and falling price, make a profit. Speculator, they wanted to always make a profit. Balance of payment is calculated for one accounting year, one calendar year, one business year, one average year. So balance of payment is calculated for every accounting year, which are not the components of balance of payment. Balance of payment, they have current account, they have capital account, they have reserve account. So in balance of payment, you can find out goods, you can find out services, you can find out investment, you cannot find out travel. Can we go to the next one? Which of these are not components of current account and BOP? So goods, services, investment is there, travel is not there. Dash current, sorry, they are talking about current account. So the current account has nothing to do with investment. The travel can be still a part of it, but travel can be still a part of it, but it cannot, they cannot have a the investment for the current account. Dash profit is made from misprinting. Dash profit is made from misprint. 1 second, we'll correct this first. This is supposed to be. This is some current account cannot have the investment as its forte. Dash profit is made from mispricing the disequilibrium. That's the arbitrage profit is made. Translation risk is in relation to the. It is normally related to the transaction. The transaction risk is in relation to the market. Dash is a difference between the export and import of goods. That's a current account balance. In dash system, local income from sources inside the company is taxed. In dash system, local income from source inside the country is taxed. That's the residential, normal, general public, general taxation system. Dash tax is charged on the passive income earned by an individual, corporation of one country within the tax jurisdiction of another country. And that is a withholding tax. Withholding tax, because we are withholding into your own country. Few tax system is explained out over here. Dash offers minimum or no tax liability, so that's a tax haven. They don't offer you, charge you anything. Project is a process of checking project viability, project analysis. If you do, then you come to know whether you can actually work on your project or it is just on a piece of paper. If NPV is positive, we accept if NPV is positive, we accept the project viability. Dash does not involve the discounting factor. That is, it does not make use of a time value of money. And that's more because it is a traditional technique, the accounting rate of return. Internal rate of return is calculated by equating net present value as 0. Then you calculate the IRR. Dash management ensures the flexibility to the investor's portfolio. That's a portfolio management. Then dash risk is the time of a foreign exchange risk is the foreign exchange risk is government risk. Is a government risk. Dash is responsible for exchange rate risk. And that is what? Interest rate. Setting up an offshore company, setting up of an offshore company is not easy. It is challenging. Economic risk can be mitigated by diversifying internationally. Dash involves comparing the receipt and payment in the same foreign currency. And that is the company receipt and payment in the same foreign currency. It is called as matching. Dash option gives the option a right to sell, and that is the put option. And we will do up till 52 days. So one of the paper has been finished up. Dash against foreign exchange risk is a main objective of Forex swap. Foreign exchange risk is a main objective of Forex swap, and that is called as hedging. Dash involves simultaneous buying and selling at or set at different prices to make a profit is arbitrage. For arbitrage gain, if principal is not given, it is assumed to be 1 million, 10 lakh. Always assume this figure, 10 lakh. The NPV helps in dash the firm's value, maximizing the firm's value. It will help you to earn more profit. ROCE is a return on capital employed, is greater than the target rate decided by the management. The project should be whole, should be accepted. And the last one, the dash transaction, also known as above the line transaction, or autonomous transaction. And here was accepted. Yes, with this, we'd like to stop my explanation related to international finance. It cannot be wound up in 1 hour. It can be go into the series. But the best what I can cover, the topic of budgeting, the topic of tax liability, the topic of the bid and ask rate for the practical purpose, and for the topic of the vehicle currency and cross currencies covered. Thank you so much. I hope it will be a meaningful session for you all.
Thank you, ma'am. Thank you for that enriching session. And indeed, you have covered a lot of topics. Although international finance is a subject which cannot be taught and learned within a span of 1.5 hours, because it has so many concepts like, arbitrage. Then there is bid and ask rates. And in fact, we require so many sessions to learn the basics of what is a bid rate, what is a ask rate, what is cross currency, the calculation of currencies. Yes. There are so many things, but you have tried your best to give the maximum to our students, and I'm sure our students would have gained a lot of information from this session. Madam, thank you so much for taking the efforts of explaining the concepts in such a short span of time. And ma'am, I would like to appreciate this also, that you have solved the some of the practical multiple choice questions, so that the students would get an insight about what type of questions can be asked in their university exams.
Yeah.
I'm sure the student fraternity would have been definitely benefited from this session. And once again, I would like to thank, on behalf of S.S.T College of Arts and Commerce, I would like to thank CA Priti Parikh from Lala Lajpatrai College for accepting our invitation to be the resource person for this crash course series on international finance. I would like to thank the management of S.S.T College of Arts and Commerce for always encouraging us and always motivating us and giving us the opportunity to hold such type of sessions for our students. Secondly, I would like to thank the technical staff, the technical team, because without their support, this entire arrangement would not be possible. I would like to thank my colleagues, my support staff, everyone who have directly and indirectly contributed in making this session very fruitful and informative for all of us. Thank you so much. So on behalf of S.S.T College of Commerce, I would like to thank each and everyone for being patient and listening to this very informative session and being a part of this session. Thank you so much. Thank you, madam. And we hope to have your cooperation in the near future too. Thank you, ma'am.
Definitely. For practical part, we will be meeting next.
Definitely. Yes, ma'am. Definitely. You're most welcome, ma'am. Thank you so much, ma'am. Thank you.